The market officially hit correction territory on Thursday by getting to the painful 10% drawdown number. And although on Friday markets technically bounced, it's hard to say anything bullish about a potential bottom being in place. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we've got a red-bodied hammer candle, meaning that the opening print is still over the closing print, and buyers were unable to recapture and expand range in the upward direction. However, let's not ignore the lower wick. There is a substantial amount of buying pressure off the lows of the weekly range for a close, what I would argue is certainly in the upper 50% of the range as divided by 3s, of course. So with that, I would say structure is maybe a little bit more so neutral than anything else. I wouldn't call this the most bullish thing in the world, just noting that the close of the candle is still underneath the weekly 50 SMA, which marks the bottom end of the do or die zone. And you'll also notice on the bar to bar count, if we just segue directly into location, we've made a substantial lower high as well as a substantial lower low, and the close is outside of and underneath the previous week's range as well. So structure, although maybe the lower wick suggests buyers are trying to step up, it's not really that bullish on a bar-to-bar count here. If we're thinking about location overall and the general trend that's taking place on the weekly time frame chart, we know that we had lows, higher lows. These were higher lows. This was a neckline of a double top. Recall that we'd been talking about this for quite some time. We said last week that, hey, maybe we'll give the market a little bit of leeway here with the close right on the level. But recall also, we had said we opened inside of the previous week's midpoint of the range, the upper 50%, and I'm referencing this candle's open relative to this candle's range. A stronger market wouldn't have tested this low. We wouldn't have tested the neckline. Well, of course, the market gapped underneath the neckline relative to the close of the prior weekly bar, and then we spent the entirety of the week under the neckline. We set a big-time lower low. We broke the weekly 50 SMA. So again, leaning into the idea that, yes, we do have this longer, lower wick, but would a stronger market have even been here in the first place? The answer is no. A stronger market would have opened the week over the neckline of the double top. It would have attempted to make a move and just balance this off as just a range on the weekly time frame chart, and that's certainly not what we have in front of us. So the big risk here as we walk forward is really just searching for some sort of weekly lower high, and that could potentially be set here on a retest rejection of the neckline now. We would just call that a bearish Brigade bolt on the weekly time frame chart. Let's quickly check in on the Fibonacci's from this, which has been acting as our last major low to the all-time high. We are seeing a little bit of support off of the 61.8, beautiful, right to the number as of the low of this previous week, Thursday's low of day, of course. So it's okay. How should we frame it? It's not the worst thing in the world. A weekly close that was underneath the 61.8, a close that was underneath the 50% retracement of the overall range from point A up to the all-time high at point B. You know, it could have been worse, but it still doesn't look great. We're obviously still underneath the Fibonacci 38.2, and what we should start looking at as well is where did we land relative to this Fibonacci, the drawdown. You can clearly see that we're still, even with that lower wick, well underneath the Fibonacci 38.2, which would just classify all of this as weekly bear flag consolidation when measuring from point A to the low of last Thursday, point B. No big improvements here on the bull side of the market, even though we do have this lower wick on the weekly bar. So keep in mind, if we take out the weekly high, something that looks like this one more time is very reasonable. A small counter trend move after 4 weeks to the downside in the market from a weekly perspective after this lower wick would not be unreasonable, but you have to ask yourself the question, is there an opportunity for a higher low? No, we're technically sitting on the lowest low, so instead it has to become more about where is the potential for that lower high, and the neckline is really the critical place to be looking for that. We'll get more specific on the daily chart in just a moment with that, but before we do, let's throw on the weekly anchored view apps. You can see that the cluster is primarily above us at this point, and slowly over time, they'll start barreling down and maybe even offering confluence of resistance at the retest of the double top neckline. So that to me is much more of a bearish indication. Sure, we've closed over this anchored view app from back here, and if you really want to zoom out and use this anchored view app from the drawdown into the late stages of 2023, 573, we're well above that one. So in the grand scheme of things, has the monthly trend changed? I know we didn't get monthly closes, but has the monthly trend changed here? Not really. We're still very close to the highest highs from a monthly perspective. I know we're looking at a weekly chart. I would also reinforce the structure that we had talked about as the do or die low end of the zone. This previous weekly breakout level that offered a successful higher low above once as well as twice happening here. We've still closed the weekly bar underneath this level, which does strike me as being a slightly more bearish indication, and it wouldn't be a shock then if we take out the volume profile that of course we have closed underneath the high volume node as well. If we do something that looks like this, extending off to the left, just noting that the close is ever so slightly underneath that, we're not in the low volume void, we've technically closed slightly below the high volume node, right? Again, just another slightly more bearish data point, even though we are acknowledging the lower wick from the weekly structure. Let's take a look at the daily time frame chart. Let's get granular here and evaluate this week's expected move first. If you're not familiar with the expected move, it's this box right here. You can check out the video tutorial in the top right hand corner to learn more. If we're contained by the upper bound, we're going to be looking at 576.96, call it 577. It's still a lower high in the daily trend count, which is why in the intro, even though Friday saw a little bit of that rebound, even though the weekly bar looks like a hammer, there's nothing on the daily time frame chart that suggests that we're out of the woods. There's plenty of opportunity still for that lower high. If we're looking at the lower bound of the weekly expected move, the number is 548.75. Great confluence almost with the low of last Thursday's move, as well as if we look left here, it is also this breakout level from in the past. So the expected move does strike me as being bearish, primarily because of where the upper bound is. But one thing I want to reinforce here is the expected move still strikes me as being very small relative to the volatility this market has been seeing recently. I know it might be very dim on your screen because it's last week's expected move. If I hover my cursor, you can see the white outline of last week's move. On Monday, we smashed the lower edge. All of the consolidation was underneath, and Friday just barely rallies back into the expected move. So is the market appropriately pricing in volatility here? The answer to me is still seemingly no. Now, on the topic of expected move, because I want to talk about last Friday's little push to the upside, is it fair to say that this feels like new money buyers are stepping up into the market? Oh my goodness, this big push to the upside has officially kicked off a bottom. I think the answer is no. And again, relative to the expected move, the market hardly closed back inside of the lower edge of the expected move. If you were going to have new money buyers stepping up into this market, or heck, you could frame this in the opposite sense and say, if shorts were totally off sides here, and oh my goodness, this huge short squeeze was going to take place, everybody's going to get burnt who shorted this thing at the very lows of the move, this push on Friday should have looked like a green-bodied bar that closed here, over the daily 200 SMA, back over the daily do-or-die zone. We just didn't get that on the Friday session. So is it fair to say that new money buyers, or there's this big sentiment shift from the Friday rally? I think the answer is no. The market just did exactly what was expected of it, and it rallied back to the lower edge of the expected move. So just commentary on the general tone of what's going on in the market right now. It doesn't strike me that this is the formation for a long-standing bottom, and oh my goodness, the market's going to go on to go produce brand new all-time highs from here. Now, of course, anything can always happen in the market, but we play the probabilities game, and the probabilities based just purely on this conversation we've had so far don't really support the notion that this is the bottom. Now, from a trend point of view, we had already pointed out that the upper edge of the expected move could provide a daily lower high. I would just take it one step further and say, what are the odds that, sure, we've seen a little bit of a look below and fail. This is Thursday's close underneath, which, remember, the playbook was almost identical to the end of last week. Here's your look below and fail on Friday. Here's your look below and fail. It closes underneath on Thursday, back in the range on Friday. What's the target of a look below and fail? It's always the opposing end of the balance range. So is there anything shocking here from Friday's performance? No. Lower edge of the weekly expected move, top end of the balance range in here. The long trade, so to speak, is actually complete. You wouldn't really be expecting much more than that. And as a matter of fact, it would be totally reasonable that a rejection here keeps the weekly bearish, it keeps the daily bearish. This is nothing more, than bear flag consolidation from this perspective. It's the lower edge of the do or die zone, which we know is the weekly breakout level we just saw off to the left, as well as the weekly 50 SMA. We've actually annotated this week instead of last week. I think we were just talking about it. So there you go. You have 564.65. As long as price is consolidating underneath, one more time, let's call a spade a spade. This is a bear flag in the context of a very aggressive downtrend. And as we'll see when we go through the supporting evidence today, there's really not much that suggests across all the different data points we look at that, wow, the tides are turning and all of a sudden it's bullish. So one up day here is not really enough to change the tone of the market, even if we were to get a stronger rally through the do or die zone. When I say stronger, I'm definitely using air quotes around the term stronger. If you rally to here, you could still produce a lower high rejection underneath the daily 200 SMA, as well as the upper edge of the do or die zone. Recall that this really was originated because of the Tuesday and Wednesday low of now 2 weeks ago. So a lower high there also makes a lot of sense. And of course, we've been tracking that level as 573. Now, Matt, you've been pretty bearish here. It sounds like, the perma bull of YouTube is no more. Where would you actually change your tone on a stronger reversal potentially being put in for a move back, like constructive? Let's flip the trend back to up. Let's get back to all-time highs. A good first step would just be, okay, let's see the counter trend continue to here. Show me a higher low, excuse me. Show me a higher low. That might be a good first step. Then we could label this as the low of the move. This potentially could be a higher low, but that's not really enough after a large drawdown like this for me to say, okay, it's fine and dandy, all-time highs, here we come. I would want to at least see the market go on to produce some sort of higher high over the top end of the do or die zone. If something like that were to take place, I would definitely dial back some of the bearish sentiment, especially if it's paired with supporting evidence also making a turn here. So in the current context of the move we've seen over the last couple of weeks, I would certainly think that this is a lower probability outcome, but that's what it would take. That's what it would take there. So that's what we have on the daily time frame chart. Any other commentary here? Nothing. I guess downside targets would be useful to have. Things to the downside. So consolidation in this box, again, bear flag until proven otherwise. Lower highs here, we're probably just looking at the rotation into 541.25. There's a very small unfilled gap back here, around 536.85 to about 25. Then we have 529.50. I think it's probably useful just to see where this stuff is coming from. So this is the bottom end of this little range before the continuation. This is that tiny unfilled gap I was just talking about. Then this is also a breakout level after the August 5th panic when we actually saw capitulation, which is a great segue actually. So it's a good thing we looked left. We still haven't seen that capitulation style sell-off, that gut-wrenching, oh my god, I can't believe the market gapped down, 15, 20 handles in the S&P 500 cash, and wow, this is like unbearable. We haven't seen that. Now, we don't need that for every single bottom to be put in place, but it certainly would make a more compelling argument to start looking for a bottom after a capitulation style move. So is there more room to fall to the downside? It would certainly seem so, given what we know about how bottoms are formed, right? Typically it's on big emotion, and I would not suggest that any of the action really after Monday of last week was happening on big emotion. It was mostly sideways and small up on Friday. So that's your commentary on the S&P 500 daily. You could come in here with some trend lines as well. I'm not really a big fan of this. You could take this approach, say something along these lines. Okay, is the trend line broken? Are we flipping back to an uptrend? I would really just say it has to be this. If we get this and, notice it's both things. It's the higher low and a higher high over the do or die zone, maybe we'll change our tone. It would coincide naturally with the break of the trend line when it's that steep, so something to keep in mind, but the horizontal levels for me will always rule all. Let's drop it on down to the hourly time frame chart. We can sort of read into or look into, explore, investigate, interrogate the price action of what happened this week. And what I think I would say here, what I will say here, is if this is going to turn into a double bottom, then that's fine. You just have to get over the neckline. And one more time, like this is a reasonable thing to take place. We know that the weekly has room for a lower high. If you reject here and you don't hold the higher low, this is nothing more than just a lower high from the weekly perspective, right? And then you could say Brigade bolts here, bring you back down to the equal lows. Then we're looking for follow through to the downside and some of those levels that we were just talking about from the daily point of view. What I do want to spend maybe a little bit of time talking about is just the notion again that Friday really wasn't a big emotional day to the upside. It was like we moved to the lower edge of the weekly expected move and went sideways. This is not big short squeeze. This is not shorts in trouble. This is simply, okay, maybe the shortest short at the bottom end of the move is squeezing out maybe a little bit. But look at the first hourly bar, look at the second hourly bar. That's the only sort of large bodied bar of the session, and then it's completely sideways at the lower edge of the expected move. So when I'm thinking about how markets should respond to, oh my God, shorts are absolutely screwed down here, right? Or, wow, I can't believe that new money buyers are stepping into the market. We have this huge trend day to the upside. That's just not it. That's not what it's going to look like on the hourly time frame chart. You're going to get large green-bodied bars that look like this, maybe 3 or 4 of them. Then they'll get a little bit smaller as the day wears on, but you get something. This is exaggerated, of course, and we're just drawing on the chart, but drawing on the screen, you get the idea. You're going to see multiple large green-bodied bars, and that's just not at all what Friday was. So just getting back to the whole point of the argument, is this a firmer bottom in the market? It's hard to say anything that's overwhelmingly bullish about this type of move here. Let's quickly check in on the intraday anchored VWAPs and see what we can learn. So this, of course, the top one is from the all-time high. From there, the last major lower high, I would say, before going on to produce this big lower low. This is the rejection. Recall that this is where there was the potential for tone to shift out of the market. This was maybe an hourly double bottom. If we had opened here and gone, different, right? So the fact that this is a failure then strikes me as a reasonable point to anchor a VWAP to, of course, Monday, and then the low of this move outside of the failure on Thursday. We're above some of these anchored VWAPs, and again, maybe we maintain, at least into the early stages of this upcoming week, a bit more of a neutral stance in here in the context of an overall downtrend, but you would really have to see this Brigade bolt before it's even interesting for upside. Get me over this cluster of VWAPs. This is still, first base case thought is this is still just a lower high rejection point. As long as we're under the do or die zone low, let's not lose sight of momentum, of trend, of technical structure. It's just possible that a daily lower high is here. And even if we go beyond that, it's possible that a daily lower high is here. Weekly lower high is there. If we go here, a weekly lower high is there, right? So base case still remains looking for rejections of 564.65, rotations back to the bottom end of the balance range here. Any breakthrough or follow through should bring us towards that 541.25, 536 zone as a gap close down here. If the market just gets consolidation, and let's just say that there's not enough of a test here, or there's not a good setup for risk reward that offers this, then executing in this box might be a very difficult thing to do. And it's okay to just look at this and say, all right, bear flag consolidation, but there might not be anything to actually do in the midpoint of that range. It might require some patience before we actually Brigade bolt under the flag and start to get some follow through into those next targets, which again is a very reasonable outcome, right? Where you get this consolidation and then maybe midway through the week. Keep in mind that we do have the Fed this week. We also have a triple witching. There's an interesting conversation there about volatility that we'll have in just a moment, but there's a number of catalysts. It's not unreasonable that the market could see some follow through underneath the lower edge of the expected move again this week. We've done it now 4 weeks in a row. We actually did it back here. I know the box is off the screen now, but generally not outside the scope of possibilities. We've already talked about what would be required for a reversal to the upside to really get me interested. It would have to be this consolidation here. So I'd be neutral, and the primary idea would still be this on a move back down under here. The time where I change my tone is if this does hold and here goes on to produce price acceptance, some sort of higher high over 573, I'll start to become a little bit more open-minded to a structural change, right? Obviously, you'd start to be bringing in some sort of higher high here, lows, higher lows. All right, we could start talking about a short-term uptrend that's trying to build, right? So that's the commentary here. I really don't think that there's enough going on to make a bold claim that, wow, a bottom's in and, oh my goodness, markets are due for a massive rally and all-time highs. Here we come. Let's come from this lower high to the bottom just to see where the 38.2 is. Kind of a no man's land here inside the do or die zone. So I wouldn't really read into that too much. We're just kind of going to throw a couple of Fibonacci's on here. Not that any of this is too precise. 38.2 is in here when measuring from this last lower high. That makes a bit more sense. If we come in here from this lower high to this, 61.8 is almost baked into this level. So we're getting a little bit arbitrary with our attachment points there, but I think that some of them, and maybe take them with a grain of salt, but some of them validate this as being an important zone around that do or die level that we've pointed out already and talked about in quite a bit of detail. Let's take a look at the market internals, which can be slightly deceiving here. So if you're not familiar, take a look at the video tutorial in the top right-hand corner to learn about what the market internals, are, what they're sort of suggesting. But you'll notice on Friday's big rally to the big air quotes, right? Big rally to the upside, which is really not that big. We are seeing substantial volume inflows. You're in trend higher zone all day. The index score is strong, and the tick actually does end up closing out it's positive here, but it's not near our substantial threshold, which, as we know, is 5,000 in the S&P 500. I just want to point out that under the premise of a look below and fail, meaning that the market broke underneath these lows and closed here on Thursday, to then open over that level means that across the S&P 500 and through the internals dashboard here, therefore the NYSE exchange, a number of companies, as soon as Friday opened up, were opening over the previous day's settlement. This reads from the settlement. This reads from the settlement. This reads from the open, which is, we'll give some credit where credit is due. I'm not trying to detract from what Friday represented. It was certainly a counter trend move in the context of the aggressive downtrend we've talked about so far. But these things don't really surprise me as being strong, apparently strong volume inflows on the upswing, or even the advanced decline line staying in trend higher zone. It just means that across the exchange, there was some degree of correlation to the upside. And I think that's characteristic of the shorts from the end of day, on Thursday, being stuck in a really rough spot. But generally speaking, it's still based on when you add this together, this is why kind of context and screen time matters. When you add this together with the actual price action from the index on the Friday session, I still think it's a very difficult argument to make that new money buyers are stepping up. Maybe it's a little bit of short squeeze, as we've said already, but that's about it. It's not really like, wow, I can't believe that the market was up, so aggressively on Friday, and we're going to get follow through here. So that's my take. I did want to address it here with these reads looking like they're substantial, but it didn't feel substantial with the tempo of the market and really just the range that was traveled being not substantial. We'll frame it that way. We're still inside of the balance range. We're still underneath the do or die zone. We're well underneath the daily 200 SMA. So let's move along to the market profile on the ES side of things. And what I think is noteworthy here that might suggest that the market could continue the counter trend a little bit, but still in the context of a downtrend, right, is that your Thursday value was lower in the session, and Friday is clean to the upside, meaning that it broke away from the Thursday value. Point of control is also outside of and above the Thursday high. So it begs the question, if buyers did step up here, what's the key level to watch? It's clearly just Thursday's high and the value area low. It's half back of the Friday session. If these buyers are going to be validated, you probably don't want to see price underneath this level. You will look for consolidation in the upper 50% of the multi-day balance range, which is really here, and then potentially a break through that brings you to what? In the SPY, we were just talking about 573, and in the ES futures, if we just, let's go back over to this chart so you can see the next level above. In the ES futures, we would be talking about that 5750 level, right? 5750 to the upside, then seeking some sort of lower high, right? So I still don't see the compelling argument, and that would be this, right? This consolidation here, Brigade bolts over 56.50, 57.50, 100 points higher is the target in the ES futures. And this is all stemming from, right, the idea that value and point of control did subtly shift higher on that Friday session. Now, the flip side of the same exact coin is just that, okay, if buyers in theory are transacting here, or if more participants, let's just generally bucket them as participants, not necessarily longs or shorts, because we can play both sides, any breakdown through this level clearly just brings in a lower high and we'll look for the equal low. Why would that be the case? Because again, you can play both sides of the same coin here. If you're long from the value area high, how do you feel on a breakdown underneath the value area low? Longs probably feel like this. If you're short, trying to seek a lower high at the top end of the balance range, how do you feel? Shorts probably feel like this. So who wins in this outcome? The shorts do. Absolutely. So Thursday's high starts to become a pretty important inflection point just based on this quick look here at the value area and the market profile. You'll also notice that, one of the typical things when the market's really squeezing aggressively, or when we have new money buyers stepping up and it's just a strong move to the upside where it is larger players getting involved, your profile is not going to look like this. It's not exactly a P-shaped profile. You've got a little bit of, usually you want single prints down here. Point being is, the market it saw a little bit of a rally and then it went sideways. It did absolutely nothing. A stronger trend day is going to be a thin, drawn out profile that does not have any, what you could consider, quote, clumping at the highs or lows of the session. I think it's interesting to point out that we do have an M period spike. We'll watch out for that on the Monday open. Do we open in the spike, over the spike, under the spike? Spike rules will be in play. So we'll watch these things. But generally, I think that your Thursday high, value area low, half back is going to be the much more important talking point here, or just key level to watch as we move into the early stages of this week for whether or not the counter trend is still in play to the upside. I will just point out quickly that there is a lack of material excess at the low of the Thursday session. The auction is not properly ended down here, so it wouldn't be unreasonable that if we do see a breakdown into Thursday's range, any sort of attempts or tests of this should cause a breakdown on the first go through. Let's move back on over to the platform here. Let me, I don't know why we're resetting that. We want to reset this. And we want to take a look at the QQQ NASDAQ 100 through the lens of the weekly time frame chart first. And we'll clean up the drawing set here. Okay, so very similar commentary relative to the S&P 500, where the structure of the weekly candle, of course, is a hammer-esque style bar. It's still red-bodied in nature, meaning that the open is, of course, over the closing print. There's not as much of an upper wick, but you'll still notice that we have on the bar-to-bar count a big-time lower high, lower low, and a close completely, it's right at, basically, the prior week's low. One more time, the argument here is just if we had a stronger market, you would have seen an open in the midpoint of the previous week's range. You would have seen an attempt back at the highs of the previous week's range. You would have seen the market attempt to move back over this very important pivot point from the weekly perspective. It just didn't happen. We broke underneath the 50 SMA. We broke underneath the previous week's low. We set a new lower low. It's definitively bearish here on the QQQ weekly chart as well, even with the acknowledgement to that lower wick. And I would just point out from a trend perspective, sure, you still have your double top. You from here to here have a lower low, and therefore your lower high is still easily on the table anywhere underneath the neckline around that 503,500 mark. That's the zone that we'll use here on the QQQ weekly. If we check in on our Fibonacci's from the same August panic low to the all-time high, you've made a move to the 61.8, a small overshoot here on the NASDAQ, but nothing that I would really read into. I would just continue to build the argument that still a rejection of the 38.2 keeps the market slightly more bearish on the weekly perspective underneath the neckline of the double top. So there's nice alignment from that point of view. Let's check in from the top to the bottom and continue to talk about how, again, bear flag consolidation technically takes place under the 38.2. It's not great alignment. It's technically underneath the neckline of the formation, so still bearish from that point of view. And we could check in on the weekly spread of anchored VWAPs underneath a majority of the cluster, with once again them starting to barrel down and providing opportunities for lower highs here instead of supporting for higher lows. It doesn't strike me that even if there is a rally, there's plenty of room to set that lower high and rotate the market back to the downside rather than completely clearing the cluster, setting a higher low above, right? This clearly would seem like lower odds into the upcoming week's worth of trade. Maybe I'll have to bite my tongue depending on what Jerome Powell has to say to us on Wednesday, but when playing a probabilities perspective, certainly seems like the lower high is a reasonable thing to be thinking about first. Let's check in on the volume profile on the QQQ weekly time frame chart just to understand where we're at relative to this high volume node. We did technically close underneath. One more sort of win, if you will, a check mark for the bears on the weekly. Let's go back down to a daily time frame chart and let's evaluate the weekly expected move here. One more time, I do think that these are slightly inappropriate weekly expected moves. They seem very small with the back-to-back breach of the expected move we've been seeing over the last month and a half or so. Upper bound is at 494.65. Great confluence near the daily 200 SMA. Nothing more than an opportunity for a lower high. Remember, and we didn't really talk about this on the ES side or the S&P side, but there's still this concept of overhead supply in the market, which can clearly still weigh on price, causing that lower high to become more likely, right? So this is still in force, and we are getting that alignment at the upper bound. The lower bound is at 464.66. That is implying a slightly lower low than Thursday's low of last week. One more time, if we breach the expected move, it wouldn't be unreasonable for some of these next targets to be in play. 460 and 451.15 if I look left to show you where these are coming from. It's the breakout level. We talked about a similar style level in the S&P 500 as well as the low of that breakout zone. This is after the August 5th. This is the next major higher low in the trend count, right, from here to here. So those would be the next targets to the downside on an extension. This is almost a rinse and repeat conversation where we can just say, this is really nothing more than bear flag consolidation on the lows. You could even come in from these sets of equal highs, which were not breached, but we'll come in from here down to the lows. This is happening underneath the Fib 38.2, which is just beautiful confluence as of literally Friday's move back to the upside. Let's see if we can adjust this. There we go. A little easier on the eyes. Look at the level. I mean, 480.25 is spot on with that bear flag consolidation. So to me, bears still in control, plenty of room for a lower high. If there is a counter trend move, maybe something that looks like this, then seeking a lower high here. First move is back to the top end of the range, through the range, and then the bear flag opens up for further downside. I might be willing to change my tone if this offers some sort of, I'll use dotted lines first, right? This gets me a little interested in the upside, and then definitively on some sort of higher high from here to here, start thinking about, okay, maybe there is the potential for some sort of stronger reversal in the market. But until that actually happens, I don't think that it's we don't want to lose sight of the fact that the weekly chart is in jeopardy. The daily has been in jeopardy for quite some time now. I think that we were appropriately on time with when we started saying, hey, there are like some larger structural issues actually taking place here. And forecasting that, like, this is more than just like, okay, pull back looking for a higher low. It's sort of getting a little bit more extreme than that. So anyhow, conversation is still that the base case is seeking lower highs and continuation to the downside because the supporting evidence just isn't there. This is not new money buyers stepping up. Same commentary relative to the S&P 500. We could drop it down to the hourly. We can see similar things. Your double bottom might be a little bit more clean. One thing I will say that it doesn't really support the notion that I've been setting forth as maybe the major idea, the base case, which is that sellers are still being very aggressive here. And we, of course, have to acknowledge these things, right? Because I don't want to overlook something. But what I want to point out is look at the 470 level, okay? And we'll zoom back in on the recent price action in a moment. But if we look back at what originated the 470 level, let me zoom in on this. What is this? And this is where I really think that we do our best, right, in terms of bringing in an unbiased view of the market. This is thin structure. This is like there's no support in this straight up rally to the upside. Okay, so under 470, the market doesn't really have a lot to lean on down here. Let's go and take a look at the Thursday, Friday, or Tuesday, Thursday breakdown of 470. You would think with poor structure under that level, there should have been like an acceleration down here to at least get to the 460, 10 points lower. It just didn't happen. So I'm not going to sit here and say that like sellers failed completely and oh my God, this is the bottom end of the move and like all-time highs are here in the blink of an eye. I'm not going to say that because I still think that there's a lot of pain points on the weekly time frame chart that have not resolved. The daily time frame chart still clearly in a downtrend. But I would think with thin structure down here, sellers maybe should have made a stronger move. Now, one counter argument to this point is just that, well, no, the market technically was at the lower edge through the lower edge of the expected move, expecting that the market was going to continue for like a 3 sigma move outside of the expectation is asking a bit much. That's maybe something to read into, but that little commentary here about 470 I think is useful to bring up. It helps us keep an open mind to perhaps better than expected outcomes, which by all means, like, we'll say the market's bearish when it's bearish, but just like the next person, I would prefer, right, for longer term holdings that the market quickly and promptly flips back up into an uptrend. So I'd like to keep an optimistic and open mind, and maybe that 470 failure to continue lower underneath helps us do that. All right, so 480.25 I think is very clear as a neckline, obviously from the double bottom perspective. I think in here is just no man's land. It's bearish consolidation. We don't want to jump the gun. So if you can get a higher low in here and then Brigade bolt out of that, I think that's a decent risk reward opportunity for the counter trend when we get here, looking for the lower high base case as we've set forth so far across a number of the different charts we've looked at. So here, looking for a lower high, back down to this level, reevaluate. Base case should suggest this gets continuation. If we get something that rebounds off of it, right, and we do something that looks like this, I change my tone here. This is where we're a little bit more optimistic about the market going on to change the trend over time. Maybe there's a more structural bottom that builds out instead of an emotional one. So this is that. Of course, consolidation in here, I think we've already talked about this, right? But this is fine. Brigade bolts for a bear flag breakdown, 460. Remember that this is thin structure underneath the Thursday and Tuesday lows. And then, of course, anything beyond that, 451.15, coming from the bottom end of that prior zone we explored on the daily. That is what we have here. We can quickly check in on the intraday anchored view apps. We won't really learn a ton. I think that it's rinse and repeat of the S&P where, okay, if we get over this level, it's a good first step. This is probably a trade and then seeking some kind of lower high off of that 492.50 if the market gets there in the first place. Upredge the expected move is Confluence Daily 200 SMA. Anchored View app is in here. We've talked about this level in quite a bit of detail. Let's move along to the NASDAQ side of the market internals. Let's see if we can learn anything new here. You're going to see the same thing where you have what appears to be really strong volume inflows, advanced decline lines positive, and okay cumulative build. It's not the strongest thing I've ever seen. And one more time, I would just remind you that it's important to take into context the actual tempo of the move intraday on Friday when the internals look like this. This does not strike me that new money buyers are getting involved, regardless of what this sort of says. Remember that this really does not, it doesn't take in any context clues. It just says, okay, Is volume flowing into stocks that are over the previous day's close, or is it flowing into stocks that are under the previous day's close? And with the disjoint we had talked about in the ES, it's the same thing here with the open over the previous day's settlement on the NQ as well. All right, let's jump into our market profile, NQ side of things, and we'll quickly check in here. Just rinse and repeat conversation. Again, poor low, this poor high was repaired. The value area on the Friday session was not as substantially higher. I will still say that the point of control is outside of the Thursday range. I think it's the same comment where if we get this consolidation over halfback, over Thursday's high of day, this in here in the value area, if we validate that, we can look for that counter trend in the upward direction, and we've already covered what those numbers are over on the QQQ. 480.25, consolidation in this range, stay over the Thursday high. We could mark that out if you want. I don't want to get too level happy, but 476 would be your number there. Over 476, under 480.25 is the consolidation. This is the Brigade bolt, reevaluating for a lower high here. Pretty clear. We've been pretty consistent on that analysis. Let's go back to the IWM. Let's take a look at small caps on a weekly chart. And let's move down into a clean drawing set here and see what we can see. We've got ourselves a hammer on the weekly, just like we've seen on the Qs and the S&P 500. This is at the, I was going to say daily, but the weekly 200 SMA. It's possible that there's a small counter trend off of this move, but we've been talking more bearishly about the small caps for a while now based on the premise that we have left, head, right shoulder. We're underneath the neckline from a number of different perspectives, or underneath the weekly 50 SMA. There is no do or die zone here. It was sort of, the do or die zone was way in the past, right? It was this. It was show me a higher low. Okay, there was some overshoot. All right, try again and sayonara, right? So the fact that we're so substantially underneath that just offers the lower high opportunity to continue the weekly trend in the downward direction. Lows, lower lows, and of course the lowest low in the trend count here at the weekly 200 SMA. We are coming towards the lower bound of what I would consider was a reasonable amount of consolidation before this attempted breakout in here. I would sort of maybe keep an open mind to, if small caps can slow down in this consolidation, maybe it starts to provide a little bit of air cover to the S&P 500. I'm not going to sit here and say it's the end-all be-all for the S&P, but in terms of intermarket relationships, it might be worth considering. If small caps slow down, if the bleeding, let's say, lessens in terms of its velocity, it's still a bearish-looking chart. Don't get it twisted, but if it's starting to consolidate, maybe it slows some of the pain in the S&P 500. Just something to keep in mind on these higher time frame charts. As we zoom out, and zoom out from this perspective as well, let's go to a 10-year chart just so we get plenty of price action to look at. I think it's paramount that the monthly time frame chart says this is it, right here, right now, right? The top end of the previous weekly balance range. If this is going to hold, it's, as I've said, sort of like do or die, right here, right now, weekly 200 SMA. If it slows down, it's something to pay attention to, but it's probably not enough of a bottoming signal. I would frame it that way, right? It slows the pain down, but it doesn't inherently mean that a bottom needs to be in play. It's in the midpoint of this overall range, which doesn't really tell us a whole lot. Let's come in from a fib from here to here, obviously underneath the 38.2, and even if we do see a counter trend move, a beautiful lower high could be set on the neckline retest up around that 215 mark. We'll also come in one more time from this high. Let's come in from this. That's the origin of the breakdown down to here. Still underneath the 38.2, 61.8 would also act as your neckline. And again, a great confluence with your weekly 50 SMA. 216, 215 is where we're looking for any stronger counter trends to find the lower high and continue to move in the downward direction. Anchored VWAPs on the IWM side of the weekly. Underneath the cluster, barreling down on the level, not much to really write home about in here. It's just confirming everything we've talked about so far. One thing I will say, and I think I maybe spoke or just glanced over it too quickly on the initial pass here of the small caps. We did not stick to our candle structure and location analysis. And what I would point out here is this is the only index that closed back inside of the previous week's range. It's not compelling as in like, oh my God, there's a bottom here. Again, I want to be very clear about that. It still seems like a counter trend relative to the overall breakdown we've seen on the higher time frame weekly, but it did close inside the prior week's range, unlike the S&P and the NASDAQ. So if it's going to stop some of the pain over here, it looks like this is the upcoming week for it to do so. We'll carry that forward in the narrative. Let's come into the dailies on the small caps here. Excuse me. Weekly expected move is showing us that we have 209.54, and then we have 196.25. If we get a rally to the top end, it's still a lower high in the grand scheme of things. This maybe suggests that this possibility for the inverted head and shoulders on the daily could be the stronger reversal pattern, but one more time, I would really need to see it go on to produce a higher high relative to whatever is set here before I change my tone more aggressively. And let's not also forget that the new balance / old balance / all of the balance range from this area is still huge overhead supply. And recall that this would be the weekly lower high zone that we were just talking about. Is it possible that you flip into a daily uptrend to get there and then reject for a weekly lower high? Absolutely. We know that lower highs, a firm lower high in the weekly trend count, can only be the result of actually flipping into a very short-term daily uptrend. So that makes sense there from a trend count and sort of Russian nesting doll perspective, the way that we view trends. As you could say Russian nesting dolls, concentric circles, so on and so forth. Any consolidation down here speaks for itself. There's probably not much to do inside of this actual range. So underneath 204 and yet above 198, bearish consolidation down here. Obviously, Brigade bolts underneath the 198 through the lower edge of the weekly expected move. Target the next levels below at 191.75 and 187.75 down here as well. So that really covers the daily charts. Let's go to the hourly chart. We already looked at, and I guess we could just do it here on the hourly again, but if we come in from the origin of the breakdown to the lows, just reinforcing that this 38.2 is near the upper edge of the weekly expected move, that 208, 210 zone, if you will, still to produce a lower high. Something that looks like this on the hourly is fine. You could trade counter trend to get there. You could experience this as a bullish tailwind for the S&P 500, but when we get here, still makes the most sense that you're seeking that lower high first as a component of our base case now that the trends have flipped to down across basically all of the time frames here. Let's quickly check in on the intraday anchored view apps for the small cap side of things. You've recovered a little bit of the cluster here, and I think that the breakout is just reinforcing that 204 level with the anchored view app from this last lower high in the major trend count / breakdown, if you will. There's not much else to read into, just a lot of rinse and repeat commentary relative to the tempo and size of the bars from the Friday session, so we will spare you the hot air. Let's come into the Russell internals, rinse and repeat over here. Again, I'll save you the time. Let's move along into the market profile side on the RTY, and I'll save you the time here. There's value on Thursday, here's value on Friday, clean to the upside, point of control the whole 9 yards. Poor high, lack of material excess, not as much of a spike on that Friday session here in small caps. I think that the breakout level is very clearly defined, especially over here on the cash chart at the 204 mark. All right, let's jump into our S&P sectors. Let's see what's going on from this point of view. Who was leading, who was losing, and where was the weight this week? Semiconductors actually led the pack up 3.19%, followed by utilities, then energy, and then we can even come down into financials, because I think it's noteworthy, financials being the second heaviest weight sector, they technically closed the week out green, up about 50 basis points there, 48 technically, 0.5%. The bottom end of the barrel, it's consumer staples, and the reason this is interesting is because we know this is risk on. This is sort of risk on here in financials. This is risk off. It was down the most. Discretionary, though, it's risk on. So, okay, that's a little bit of we'll put a check mark as risk on, but it's a red flag, of course. Real estate, less meaningful. Communications are risk on. We'll put another check mark there. So, a mixed bag in terms of the actual performance of the sectors. As we look at the individual charts, though, I think this is the most revealing part. It would seem to me that although, yes, semiconductors led the pack on the week, is there anything here, and this will be the question that we ask through a number of these charts, this is primarily what we did on the S&P 500, although the market rallied on Friday, is there anything here that substantially changes the trend of the chart? Is there anything that substantially gets us back over this overhead supply? No. It's like, okay, we've got this little inverted head and shoulders, and we talked about this on the Wednesday session, right? And we did get a little bit of follow through to the upside, but nothing really changes here if there's just a lower high rejection at 237. So sure, the market can see a counter trend move this week. We saw the weekly hammer candle in place, but even the top performing, and this is not a direct sector, but it's maybe an industry, right? The top performing risk on industry is still not out of the woods with a potential lower high underneath 237. So sure, show me a counter trend that continues and get a bunch of people excited in the S&P 500, the NASDAQ, if you will, But until we can actually clear this level, I'm not convinced that it's time to start hooting and hollering and that, oh my God, all-time highs are going to be here in the blink of an eye. So that commentary will persist through a number of these charts. Utilities is a lightweight defensive sector anyhow. It's really more neutral in this box. Let's not read into that. Energy, midpoint of the range. There's actually some great trades on some energy names that you'll see towards the end of today's episode. As we look at financials, it's just the same comment. It's green on the week, but what more has it done other than just like small counter trend moves starting to break over these highs? Some thin structure to retrace, lower high here, and like we don't want to keep our bear hat on forever. At some point there will be like a higher low and we'll have to change our tone to being like, okay, this is constructive for the upside, and we'll become less and less and less concerned about overhead supply. But in the initial innings, if you will, of the reversal, you either need a highly emotional bar that looks like this, huge squeeze to the upside, or it's just literally going to take time where it's okay, market does this and we build out this uptrend over time and we have these structural higher lows and we can see the shift in the structure. But the first go around, let's not lose sight of like, this is the threat. So not much change here structurally about a trend change, rather, I should say, in financials. Let's get into consumer staples, breaking down through the 80 level, giving us a bearish confirmation here underneath this, now acting as all overhead supply, lower highs available here, gap fill reversal. Remember, this was acting like, okay, consolidation, not everything's, blowing up. Well, now things are definitely getting worse in staples. As we look at discretionary, no help over here. Still plenty of room for a lower high, right? So we're not out of the woods from this perspective, and we also don't have this big emotional bar from the Friday session. Let's move along to real estate, lightweight sector, not much to read into over here. Communications, definitely more of a risk-on sector. It's what, 5th heaviest weight? Small counter trend on Friday, plenty of room for a lower high, not out of the woods from a downtrend perspective. This head and shoulders up here kind of kicked it all off. Underneath the daily 50, still over the daily 200, but round trip, I think, maybe tying into the counter trend thesis is just round trip into the lows, probably due for a little bit of a counter trend move, seek some sort of lower high. If it blows right through it, great, we'll change our tone, we'll raise our hand when we have to. But for now, base case, something that looks like this, keeping the broad market bearish. Healthcare, it was helping back here, just like consumer staples were, and now not so much, right? All this bullish consolidation from this box looking like great. The right shoulder's really holding up beautifully. Now it's in question. Now it's not so much in question where, oh my God, we're going to take out the head of the pattern down here. We're going on to set a new lower low. But it does suggest that, okay, this maybe brings in a little bit more pain. And even the defensive sectors aren't really doing so well for the S&P 500. Nowhere to hide, right? XLB, which gets us, this is why it's so fun to talk about markets, right? If there's no place to hide, that gets you closer to that capitulation style bottom, which maybe will actually offer a bit more of that stronger, trustworthy bottom, if you will. We're not there yet. XLB, lightweight, nothing to say about this. It's bearish, obviously, underneath this overhead supply. Industrials, bearish, making a new lower low, suggesting the possibility of a lower high happening in here. We'll take a look at the XHB after both of these sectors, sort of relevant to that, making a new lower low on the Thursday session. Home builders have been suggesting risk off for a while now. Let's get back on over. TLT, so bonds catching a little bit of that bid here. It's a very logical place for that to take place. What's interesting, and we'll continue talking about this, I mentioned it earlier, and I hate to keep leading you on, but the CPI print came out, right, and it was better than expected, and rates didn't really do much, right? And I think that's because the market had done the job for Jerome Powell in anticipation that things were going to get worse instead of better, and there was going to need to be an unnatural intervention. So the fact that this is finding support here ahead of the Fed announcement, it's, to me, and on the heels of a good CPI print, not really thinking too much of it. It seems very technical to me as of right now, less so driven by the actual release of the numbers. Let's move into the XLK, and then we will get into some more supporting evidence here through the sectors that suggest that we're not out of the woods. Just like the, of course, SMH, huge overhead supply, nothing to say until, it's that same conversation. In the early innings, it's lower highs. Over time, if a big structural base builds out, we'll change our tone and when the time is appropriate, but we're early innings here. There's no squeeze bar. There's no, oh my God, shorts got absolutely pummeled, and we got a bar that looks like this, and then day 2 follow through gets back over the range. This is not even in the cards. Not even a conversation point as of right now. It's a non-starter. So lower highs are still the name of the game here with plenty of overhead supply. Are you getting into some areas of potential support? Maybe. Until we have a structural trend change in the short term, I wouldn't jump the gun on your XLK. Let's take a look at the actual ratio charts here. and see what else we can learn. This is not suggesting that we have a risk-on environment. We're still underneath a downward sloping 50 SMA. Sure, you could start to say, oh, look, an inverted head and shoulders, though. Fine, maybe a small counter trend, and I think that's been part of the narrative we've talked about so far today. It's always something that's possible, but maybe these charts start to suggest it's perhaps a bit more likely. So not out of the woods, but maybe counter trend. This looks okay to me out of financials, but the structural chart, as we explored, has plenty of room for a lower high. This is D for defensive, so let's maybe say neutral over here, and this just doesn't look good at all out of discretionary. This looks like a mild pullback in a new uptrend, so that's risk off, and this is sitting at the highest high in its new developed uptrend, and that, of course, would be risk off. Let's take a look at some specialized ratios here. We can see that this perhaps is a counter trend, but still clearly plenty of room underneath the daily 50 SMA for a lower high. Same thing happening here, risk off. We'll put an X here as well. Risk off. This is risk off down here as well. Even ARK-K is risk off down here. It's tough to find anything that's compelling, that's suggestive of like, wow, there's a change in tone out there. Buyers are back, and they're back with a vengeance, and there's this big outperformance and risk on. Everybody wants a piece of the action. It's just not there. Friday's move, it was not it. So dollar plummeting, a week of just sideways sort of towards these lows. We had the conversation last week. I don't think we need to repeat it all, but we'll just go back to the 6E, which is the euro, of course. Getting a little bit of follow through in the upward direction here. Just continues to look like, in my view, money coming out of the US. This is tariff based. This is policy based. It's sort of really taking in a geopolitical what would you say, framework to understand maybe why this is happening. But the euro strengthening, of course, makes sense that money is coming out of U.S. equities down below in favor of higher rates at domestic markets, right? And you can see the same thing out of the 6J, which we know is the yen. Small uptick happening over here. One of the things that, of course, continues to be a concern for some folks out there is, oh my god, the yen carry trade is blowing up. Remember that this had to be paired with the actual Nikkei seeing a pretty substantial drawdown. Yes, it's moved lower here, but not nearly to the degree of capitulation style, oh my god, that's a gut-wrenching move like what we had in August of last year. It's just not, it's a non-starter. Let's take a look at interest rates. Actually, let's go to gold first. Speaking of risk on and off sentiment, and it's so weird, Thinkorswim broke some data on Thursday. It looks like there's suddenly a volume bar on the SPX, which doesn't trade volume, as we all know. So gold, though, mild pullback after continuing to move in the upward direction. It continues to look like a risk-off flight to safety style move, which is just, of course, going to act as a headwind for equities down below. So good to continue reinforcing that point. Now, as we look at interest rates, inverse to the TLT, of course, nothing to comment on. It's remained sideways in these lows. I think the market's waiting with bated breath to hear what Jerome Powell has to say, but more importantly, to see what the FOMC committee has to say in the SEP, the Summary of Economic Projections, which we'll get to in just a moment. Let's move along to the inverted ZT. Continuing to back off here, or at least remain stable. So still not expecting any change out of the Fed tracker tool. And you would be correct if you maintain that stance, because as we can see here, the odds have increased, and not a shock, for the pause to continue to keep rates at 425 to 450 basis points on the Wednesday meeting. So expect no change there. But what we really care about is whether or not the SEP Summary of Economic Projections outlines that the market should be expecting 3 rate cuts in 2025. Should we be expecting 2 rate cuts? That's what it was based on the last SEP from December. Should we go down to 1 rate cut? What does the Fed think about inflation? All of these conversations are much more important than the, same old conversation. Oh yeah, of course we're expecting no change from rates. So it's really this, if we take a look, it's this economic projections data point here. If I just open this up, I think we can see the latest. Let's go to, we want 2024, and we want the December projection materials PDF, please. It's this document, right? You guys who've been around the channel for a while, you guys know this stuff. So the 2025 outlook right here is really what we care about. So the Fed funds rate going from a 3.4 projection to a 3.9, of course, was indicating like maybe 1 rate cut, right? Maybe, if you're lucky, you get 1 rate cut from where we were at, or sorry, 2. My apologies, 2 rate cuts from the 4.4 to a 3.9, give or take. You get 2 rate cuts. We'll see how that changes over the course of Wednesday. We'll see how the Fed's forecast for inflation changes. What about the unemployment rate, right? GDP has plummeted off of a cliff, as we know. The Atlanta Fed number is abysmal. It's negative. So we'll take a look at all this stuff, and we'll stream it live we'll probably start at 1:45 Eastern time on the 19th, which of course is Wednesday. That is the biggest event economic data-wise on the upcoming week. Yeah, we get retail sales earlier on, And on the Thursday session, it's the typical jobless claims. But really, this is the main event. This is what everybody cares about. On Wednesday, March 19th, we'll have coffee and donuts up in the penthouse for 1:45, and we'll follow through into the press conference, and we'll hear from Jerome Powell as well at 2:30. Let's get along to looking at some of the inflation data that came out last week. I think it's pretty compelling that the transportation services dropped precipitously on the core CPI, I guess this would be transportation services is a part of core. So this is technically looking at all CPI month over month, but this is, in theory, we could label it as core. Anyhow, just picking on my own words, so to speak. Big drop in that, whereas the more important thing I think to pay attention to is actually this. In what maybe it's orange, depending on if you want to call this peach or whatever. Let's not pick on words here. That's shelter. Shelter is, I wouldn't say coming down substantially, but it's certainly lower than the prior month, and shelter is the stickiest component by far in the inflation print that we've been seeing over the last couple of cycles. So this is a step in the right direction. I think we want to continue paying attention to that if the Fed's going to make progress, substantial progress towards the 2% target. The other thing, just all up, is that, of course, shelter falls into the services side of the inflation print. If you take a look at the services PMI was actually negative this previous month, and we know the actual number came in at 0 month over month there. So to see this negative out of services may be a compelling argument for maybe there is decent progress happening on inflation, and the Fed can cut rates, and it's not going to be an emergency response to, oh my God, a growth recession is on our doorstep. So this previous week's inflation data seemed really good, and I would go back to maybe the point I was making on Wednesday, which was just that you had a good catalyst, and yet the market was unable to do anything with it. And that's the head scratcher that I'm left with. Why would the market not perceive this data as, wow, great progress, let's take the money and run, basically? It just didn't happen. So as a head scratcher, it makes me think more so that the selling maybe isn't done yet, and there's still some skepticism out there. Speaking of skepticism, it might come from something like consumer sentiment, which plummeted, continues to fall off of a cliff here. This was released on Friday at the 10 o'clock time frame, and as we could take a look at the AAII server survey from, I forget even who produces this. I think it's their own thing. Yeah, the American Association of Individual Investors. It's still sitting at like some of the most bearish reads we've seen in a very, very long time. The final week of February, was the most bearish from a 1 year standpoint, right? Your historical view here. So participants still skeptical, feeling bearish out there. I think the tension is in the air. You could cut it with a knife. It's so thick. Everybody's just waiting for when's the next headline about tariffs? When's the retaliation from China? What's going on with growth and any sort of mention of the R word? Oh, these anecdotal layoffs, right? It's the market's on edge here, and you're seeing this in the data. I think we've seen it in a number of places with all these potentials for lower highs. As we look at the earnings calendar, there's not much to talk about here. We're through a majority of the earnings season. General Mills, perhaps from a fundamental / what would you say, consumer staples perspective, maybe Micron could move the semiconductor market a little bit. I'd say FedEx might have some insights as to the state of the economy. Nike, consumers, if you will, Lennar, home builders. That's really it. That's all I've got for you here. There's really not much else that's going to move the needle for the market. So with that, back to the technicals. Let's finish up today's episode. TLT ratio to the S&P continues to hang out near highs, making a new higher high on the Thursday session. This is defensive. This is risk off. Let's take a look. Let's skip bonds. Those have not really been too useful comparing them to duration recently. So here's credit spreads back to back, both of them exploding higher. This is a risk off indication, which would align with higher volatility. We will see that in the VIX in just a moment, and some other volatility metrics. High yield junk in isolation is technically bearish in terms of its divergence relative to the double bottom that's here in the S&P. So this would suggest that, yes, lower highs, name of the game, is still seeking some kind of breakdown. Now, you could make the more distant argument that this is a higher low versus this is a lower low, and it's technically the SPX that is divergent to junk bonds, but I would really focus on the short-term interactions out of this if we're going into a, quote, growth recession scare, where high-yield junk is probably going to outperform. They're probably both moving lower, but at a lesser rate, high-yield junk relative to just straight-up equities, which of course are seen as more risky there. So let's jump into our Bitcoin chart and just take a look over here. Small counter trend move, but still underneath the overhead supply. I want to see it down here at the 71.5 mark. Give me the retest of this breakout level. Where's the weekly Brigade bolt? Where's the better entry? We might not get it, but I would prefer to execute here, close to this, with very tight risk if there is going to be a trade back to the upside. The Sailor Shift tool is still nice and red, not building the case for a long there. Let's look at total breadth. It contracted big time this week. Big moves lower out of the moving average charts, as well as new highs versus lows staying underneath the zero mark here on Wednesday. It was actually substantially on a lower low. You can see this on a daily look. If we just do this real quick, there's your lower low on the Wednesday session, right? You can see the rally back on Friday. Let's move along to the RSP. Yes, you're seeing a little bit of a counter trend here, but underneath this, looking for a lower high. I would change my tone when and if it sets a higher low and respects it, and the S&P is divergent. The fact that it's sitting on a lower low with a lower low here, not a big deal. It's confirming the downside. If anything, QQQE, same conversation. 89.20 is your level. Let's look at volatility. VIX will start, and yeah, volatility collapsed here out of the 30-day, coming back to the 2050 level, but even beyond that, maybe we could take a look at the VVIX, which collapsed, notably, into the end of the week. And this makes sense as the market saw a little bit of an uptick here, and maybe some of the volatility that was being priced in based on CPI gets sucked out of the market. But does it actually mean that volatility has gone away and, wow, this is the bottom and that's it, and nobody's really worried anymore? Well, the answer is no. If we take a look at the vol futures, and we'll go over the volatility chart in just a second, but or I should say the futures / options chain. This is still in backwardation. This is still suggesting that the market is seeing more risk right here, right now in the present day than some unknown future. Right? They're inverted like this. There's more risk now than there is in the future. So why would money managers want to allocate capital to that? They probably wouldn't. So this doesn't really make sense. This is still, it's at the zero line, but coming from backwardation. And what I want to talk about here on the one-day VIX, because really SPX 0 DTE has driven a majority of the options flow over the last little bit. One-day VIX has like backed off a little bit, but what does capitulation bottom look like? Sharp move to the up. First of all, sharp move to the upside, but then pretty quickly thereafter, a move right back down into our 745 floor. Do we have any semblance of that here? The answer is no. If we take a look over at the trade tab, and let's fire up firstly volatility futures. Let's open this up just to illustrate in a different way. Here's your backwardation again, the fact that the curve is this way. A normal curve would be this way. There's more, volatility in an unknown future. Notice that this is time across the x-axis here. So this is contango. This is backwardation. We're certainly in backwardation currently, again suggesting that the capitulation bottom environment, the larger drawdown environment, is still here. It's on our doorstep. The next thing we can look at is the SPX. Let's go over here real quick. And this is just to talk about what I find kind of interesting is if you look at so this of course is just an arbitrary vol number. It's relative to its own sort of metric. So don't look at this as like out of 100, obviously. But point being is look at the volatility for the Friday expiration, which is our quad witching, triple witching, whatever you want to call it. It's the quarterly expiration with futures rolling. We have index options rolling, stock options rolling, options on futures rolling, of course. So all this stuff is showing us that there's a 24.36 vol on Friday's expiration versus on the Wednesday expiration. This is Jerome Powell, right? You can see that we have 23.35%. So the market's perceiving that there's more risk in the rolling of the options and shuffling around all of this money than there is from Jerome Powell and the updated SEP. To me, it just sort of reiterates that this is likely wrong over on the S&P 500 as the expected move for the upcoming week. It seems massively mispriced. So those are my 2 cents. Do with that what you will, but that is the final comment there. Let's jump into a couple of the core list of company charts here, and we'll move you along with 3 trade ideas to finish up today's episode. NVIDIA, just like the SMH, sure, you have your inverted head and shoulders, you're over the neckline here, there's some thin structure to retrace. Fine. Do or die level is at 129. Overhead supply, moving averages clustered right there. I think you could easily make the the argument for a pullback higher low. This is sort of a gap fill reversal as well. Something that looks like this is fine. You could try this risk reward, but do not lose sight of the fact that you are still in a downtrend here out of NVIDIA. If you catch a higher low and like over time we build this out as a higher low and okay, now we have equal highs, fine. Right? And we do something that looks like this. Maybe we start pressuring a more bullish narrative over 129, but for now, it's still counter trend until proven otherwise, looking for the lower high and then right back down to the neckline breakout. So that's my first take here. Any sort of sharp reversal underneath 114.25, sayonara. Probably looking at 104.75, the local lows of earlier on this week. Moving along to Microsoft. Let's take a look over here. This is a heavier hitter in the S&P 500 in terms of its actual weight in the index. Breakout on Friday, so the outcomes are pretty clear. You would need to see higher low consolidation over the multi-day range, 385.50, follow through to the upside, possibly for a lower high, and then we're looking for the regular trend to resume. Remember that there's huge overhead supply in Microsoft. You're not even close to being out of the woods here. You have this as a strong opportunity to the downside. One of the things that we'll continue to reinforce around the channel is just that I don't think it's given enough respect that if the trend is going to change back to the upside, yeah, of course, in hindsight, you'll always look like a genius if you bought the low. But if this happens, then you're probably not just thinking about a move to the equal highs. If you're really bullish on Microsoft, you're thinking about the all-time high, you're thinking about new all-time highs. So I'd much rather wait for the confirmation versus try to nail it early and just take a little sliver of the move. So counter trend, sure, but still thinking about lower highs here. Structural changes on the daily/weekly will only happen over 403.25 still. Apple falling off of a cliff here. Danger zone underneath 213.65, even if it does go for a counter trend. So inside bar on Friday, if Brigade bolts out of the inside bar range, you could walk up some of these levels into this zone around 226.25 daily 200 SMA. That'd be the first place that I look for a lower high. If this is going to persist as a new downtrend after making a new lower low, then absolutely. Right, this here, double top or whatever, intraday, right back down to the equal lows, and then possibly to the bottom end of this prior bottom from the August panic. If it is going to be more constructive to the upside, I would need to see a pullback that sets a higher low, and then also, like the broad market, probably just goes on to produce a higher high in here. I'd change my tone here. Instead of waiting and saying like, okay, now I'll change my tone up here, I'd probably need to see this first higher low and then a higher high. That sort of bringing in of the new uptrend on the daily would do it out of Apple, just considering that it would be inside of this range instead of firmly underneath, looking for a bottom down here. Next up, Amazon. Unfortunately, a little bit different, where just sideways consolidation down here. I think we want to take this at face value. We'll go down to the hourly on Amazon because it's a really great trader. Consolidation, Brigade bolt here. Very interested in like this outcome. Very interested in this outcome to the downside, risk reward. So really just balance rules in play out of Amazon. You could call it a double bottom. You could call it whatever you want. I would prefer to just say balance rules. You have risk reward to the upside. You have risk reward to the downside. That's 187.65 down here. And of course, just like any balance rules, you have look above and fail, rotate to the bottom end of the range, risk reward, and you have look below and fail. Rotate to the top end of the range, it's the opposite, right? Risk, reward to the top. So all four of these trade ideas are in force. If it's just chopping around the midpoint, not so much interested in Amazon. So $200.25, 192.25 key levels. Google, a little bit sloppy here. On the daily, you're coming into this prior area of what you could just dub as like value in this box, sideways consolidation, accumulation, if you will. So slowing down some of the sell side pressure, especially coming directly from the all-time high with hardly any counter trend move. This is much more so just consolidation, follow through, consolidation, a little bit of follow through on the gap and go there. So if it is going to go for this, it's very clearly 166.35 consolidation in here. Really doesn't change the trend. It's just bearish consolidation. Then level by level, you can walk it down. I'd just be cautious about being a new money short on Google smack on the lows. It hasn't really been lucrative like this. If you shorted the lowest lows here, it kind of blew up. If you shorted the lowest low on Tuesday, you really didn't get any follow through, right? So being mindful of your trade location now inside of this zone, you got to be careful of that. Next up, we've got Metaverse. Metaverse is the disappointing one, which is honestly not that bad because on Wednesday's pre-market prep, we talked about how, hey, this gap up probably is a great fade opportunity underneath the 635, and lo and behold, great follow through on the Wednesday and Thursday sessions. Now, though, the question just becomes what happens at this level. This is a very historic level here at 607.25. You could see intraday, the market's even respected it quite a bit out of Meta. So that would be my top watch out of this name. If we get acceptance above, maybe back to 635. If we get acceptance below, just call it for what it is. It's a descending triangle into the lows down here, back to the daily chart to see this underneath this stuff. And the ranges get a little bit more compressed because of how tight these levels were from in the past, but daily 200 SMA certainly comes into view as a possible target in here. So seeking downside underneath 586. Next up, we've got the Teslaverse, the Metaverse and the Teslaverse. I'll be the first one to raise my hand and say that the Monday session to me was a little bit out of the blue. And maybe that's like day one vacation brain, whatever, but I was thinking really that after Friday's session trying to print a hammer here, it would have been a better opportunity to look for a base to form out of Tesla. Now, you can see that all of the remainder of the sessions were inside of that Monday range, so it's not like you got follow through after Monday, but it does leave a bit to be desired on where's the long entry, right? It would have been best if the market, out of Tesla at least, would have held up over this massive previous shelf for the breakout and offered some kind of higher low that looked like this. On the hourly chart, we could start to talk about this through the lens of maybe cup and handle, low, higher low, could call it a double bottom. So it has to be a breakout over this, and then you're talking about a scalp to begin for risk reward along these lines. And then really, if the daily can build out, let's zoom in on this now. The daily can build out something that looks like that. Maybe there's a stronger base that forms around this Tesla 255, 250, 240. I mean, the range is huge around here, but you get the point. To me, it's still, that opportunity is still here out of this chart. It just leaves a bit to be desired in terms of where's the entry right here, right now. I think we have a scalp to begin with, retest the daily 200, and then we'll reevaluate. Like, does this or does this not really solidify as a potential trade idea is the next question. JP Morgan, what do we have out of financials? Consolidation underneath all of this overhead supply, election gap up back here. So most of the gap is closed there. It's trying to hold the daily 200. I would think if the broad market's going to go counter trend and financials are going to play a role in that, I would only look for JP Morgan as an idea like this. Either show me the higher low here, or this higher low is a thin structural retracement back to 248. I think you maybe could pull off risk reward like this, but I don't think we want to lose sight of the fact that it's still in a very aggressive downtrend, right? Netflix, similar concept. It's in an aggressive breakdown of the head and shoulders from this point of view. Underneath the neckline, clearly, the but the earnings gap has closed all the way. This seems to me like a lower high opportunity. Where's the lower high? Where's the Brigade bolt back underneath? 897, back to the equal lows, something in here. Reason being is, and we even talked about this last week, if you go to the weekly chart, quite literally, this is the reason, right? This breakdown bar now has the opportunity to offer a lower high back down to the equal lows, and now all of a sudden you're talking about not just a daily head and shoulders, but a weekly head and shoulders, really ugly underneath that 815. So we're not there yet, and I certainly would not encourage anyone to jump the gun on this sort of short setup, but that's kind of the next steps there. As long as price remains underneath 950.25, you're underneath this previous pivot, you're underneath the daily head and shoulders neckline, and it just looks more bearish, of course, than it does bullish. All right, let's get into 3 additional ideas, and then you're on your way. First one is in the medical space, ISRG, not ZSRG, there we go. And this is a very interesting looking chart because it clearly has a dominating uptrend prior to this most recent breakdown. And if we go to the hourly chart, what I found, actually, let's stay on the daily first. Slow down, Matt. On the daily chart, we have an inside 3-bar play. So bearish 3-bar play. Friday is inside of the Thursday session. These equal lows here sort of represent the improper end of the auction. On the lows, that is at your 476.35 level. And then interestingly enough, the Friday high is a retest rejection lower high underneath 493.75, which comes from this flat top breakout back here. So if the market can persist for consolidation in this range, I find that bearish, and I would look for the origin of the breakout, which was here at 455.75. So a potential downside trade here out of ISRG on a bearish 3-bar play. If you do want to go counter trend, you could maybe make the argument that shorts might squeeze a little bit over 493.75. This would be a lower tier setup. I would want to see this and this as the primary, but if it is going to go, maybe you could look for this if you really want to push the bet in either direction. If you want to keep it simple, just if this trade aligns with bearish broad market activity, this is what you're looking for, and I would focus mostly on that. So that's ISRG. Next up is Costco. So COST, and let's go to a daily chart to begin. And what I want to point out here is the aggressive breakdown from what was bullish consolidation on these highs, and a move into the daily 200 SMA, overshoot on Thursday. But look at Friday. Friday's a little bit more compelling than even what we had in the broad market because of the way that it looked underneath Thursday's lows, failed to find aggressive selling to continue, and now there's this little thin structure retracement just back to the retest of the 3-day lows that led to the breakdown on Thursday, so Monday, Tuesday, Wednesday lows. If you look at the hourly time frame chart, it very clearly starts to, I'm trying to make this so it's not so skewed. There we go. That's a little bit better. It clearly shows us the thin structure retracement here, where if you do get this little intraday Brigade bolt 5-minute, 15-minute time frame chart over 906.50, you've got a 920, 225 target. That's something worth trading for. Yeah, it's counter trend, but it seems very tight risk. Look at the afternoon consolidation here on that Friday session. So consolidation, Brigade bolt on a small time frame. I mean, you're risking maybe 6 points, not even. 6 points would bring you to 900. Likely should not be risking 6 points on that. Let's say you're risking 2 points on that for potential of, I don't know, whatever that might give you, depending on the entry, of course. If you want to use round numbers, let's just say something like, I don't know, $8 to the upside, right? So something along those lines is I don't want to say easily achievable, but it's even if you don't hit the full thing, right? That's where the $8 comes from. You don't have to get the entirety of the range, but you understand the point, which is just that there's some range to trade for. Then structure retracement off to the left. Probably stumbling through this one much more than we need to, but you get the idea. That's the Costco trade. The next trade is on one of the most hated stocks out there. We call it the Advanced Money Destroyer, AMD. And what I want to point out here is just that NVIDIA saw a nice move to the upside. Semiconductors started to break out of their balance range, right? There's that inverted head and shoulders, but AMD has lagged behind. So there's really two viewpoints to take here. Number one is that AMD is a piece of garbage, and you wouldn't touch this with a 10-foot pole, and nobody should be shocked that it's not breaking out like NVIDIA or any of the others. You have this bear flag. It's a bear flag, Matt. Why are you even thinking about a long here? Point number two is that, no, this is lagging behind. This is not really right. The market has sort of gone lower as AMD is trying to find a bit of a footing here. And maybe it is oversold on the weekly time frame chart. And there's Micron earnings happening this week, and maybe there's a pre-earnings run-up. Point being is that there might be a counter-trend move here over 101.50 into the retest of this, in which case I would say absolutely lower high here. But to get there, there's maybe a trade over 101.50 into 107.10. Can we pull off risk-reward along these lines for the laggard to play a little bit of catch-up to the semiconductor sector? NVIDIA, is it going to go hang out with the big boys, yes or no? And even if not, fine. Don't participate in the long, but then when we get here, 107.10, maybe this is the better trade back to the downside. And the Advanced Money Destroyer strikes again, just blowing up accounts of anyone who thought that this was a firmer move to the upside. If you look at the weekly, because the weekly is also a little bit more compelling, this area of support, you also have back-to-back hammers, whereas the S&P market overall is not coming off back-to-back hammers. It's a green-bodied hammer here out of the AMD chart versus the red-bodied hammer. There's a number of different discrepancies, but anyhow, an interesting idea to throw into the mix. AMD, maybe it comes back from the dead, it rises again, and we pay attention to it this week. That's all I've got for you into the upcoming week's worth of trade. Hopefully you enjoyed this weekend update. We are back at Penthouse location number 2. Thrilled to be back on the East Coast. Love it here, and excited for Monday's session. Pre-market prep kicks off at 8 o'clock Eastern time. We'll be live up here in the office. Hope to see you there. If you enjoyed the video today, learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We'll see you on Monday morning, 8 o'clock for the pre-market prep, as we just said. With that, have a green trading week, and I will see you in the next one.